Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Jay Jacobs, Head of Research and Strategy at Global X ETFs. And we know that Global X is a leader in thematic investing. They offer more than 80 ETF strategies in the US with over 35 billion in assets under management. So we are talking about thematic ETFs today. Jay, welcome back. Great to have you on the show.
Thanks for having me back, Neena.
So 2020 was a bumper year for thematic ETFs, and these were among the best performing areas of the market too. And that was thanks mainly to trends which were accelerated by the coronavirus crisis. Now, thematic investing is still very, very hot. Investors continue to pour money into these ETFs and mutual funds, and providers continue to launch new thematic ETFs. So talk to us a little bit about the overview of thematic ETF landscape and what is very popular with investors this year.
Absolutely. You hit the nail on the head with the COVID-19 pandemic really being the key accelerant for thematic investing. So if we go back to, the beginning of 2020, thematic ETFs only had about 27 billion in assets under management. Fast forward to today, that's more than quintupled. It's over 140 billion in assets. That is, a staggering growth rate over about 6 quarters. But even still, total thematic assets are just about 2% of total ETF assets in the United States. So it's still a pretty small corner of the ETF market if you compare it to kind of broad benchmark type funds or fixed income or factor funds, although certainly, thematic is probably the fastest growing. If you look at 2021, we've kind of shifted into a little bit of a different environment. So 2020 was really focused on stay at home. We saw e-commerce do well. We saw cloud computing do well, which was facilitating, work from home and remote learning. We saw video games and esports do really well because people were looking for entertainment at home. And we saw genomics do well because a lot of genomics companies were really leading in the testing for COVID-19 and the development of mRNA-based vaccines. But heading into 2021, there's been a little bit of a less focus on thematic from a COVID-19 perspective and more of a focus on a policy perspective. Really the fastest growing themes this year, you can draw a direct line to the Biden administration coming into office and their key priorities. So right now, really one of the fastest growing themes is U.S. infrastructure development, because that's top of mind for the Biden administration and the U.S. government at large. But other areas in clean tech and cannabis and electric vehicles have really been benefiting this year as well.
So you mentioned Biden administration's key policies, key priorities, and one of the key priorities is the infrastructure agenda. And early this month, the Senate passed a massive bipartisan infrastructure bill after months of negotiations. And the House is scheduled to vote on the bill next month. And 2 of your ETFs, the infrastructure ETF, ticker symbol PAVE, P-A-V-E, and the lithium ETF, ticker symbol LIT. And it appears that these 2 ETFs are likely to benefit a lot from this massive infrastructure investing. And PAVE has gathered over 3.2 billion in assets this year. LIT has gathered about 1.7 billion in assets. Could you talk to us about these 2 ETFs and how they will benefit from the infrastructure bill?
Absolutely. Well, we launched PAVE almost 5 years ago now. And, if you rewind to the Trump-Clinton debates, those 2 did not agree on much politically, but they had one area of consensus, which was that U.S. infrastructure needed more investment, and then carry that forward to, Trump-Biden, similar as well. One of the very few areas of consensus that the U.S. needs more infrastructure spending. So we've long held very high conviction in this theme. What really was our unique take on it, and what I think is one of my favorite things about thematic investing, is kind of having a different angle towards a theme than other people might be viewing it as, was that we realized that the probable winners from an infrastructure bill were not the names that people were talking about. Often every time infrastructure came up, people were talking about how this would benefit the telecoms and the pipelines and the utilities companies, the existing infrastructure assets in the United States. And we kept scratching our heads saying, wow, how are those companies going to win? The winners are going to be the companies building the infrastructure or rebuilding the infrastructure. The construction and engineering companies that build these projects, the materials that go into the projects, the heavy machinery that's being used on sites, or even the transportation that's going to move these materials and machinery around the country. So we really built an infrastructure fund that doesn't own any infrastructure. It owns the builders of infrastructure, and that's why we call it infrastructure development. We really see these companies benefiting from the passage of this bill, because if you kind of think about the life cycle of how this money will be spent, it will take a very long time for $550 billion to be put into infrastructure. First, you have to do environmental studies, site surveys, architectural designs, planning, zoning. All this stuff has to happen before a shovel even hits the ground. But that's why we're investing in companies like construction engineering companies that start at that very early stage of project planning through the last nail being put into an airport so that it can reach 21st century standards. So we're really excited about really being able to invest across the entire life cycle of how this $550 billion additional dollars will be spent.
Very interesting. Now, I also wanted to talk about some of the areas that you mentioned were big winners last year: cloud computing, clean energy, cybersecurity. Now, these areas, it seems that they have lost some momentum this year, both in terms of performance as well as for asset gathering. But what do you think about their longer term outlook? Should investors stay invested in these ETFs in these areas?
We saw a paradigm shift in many of these areas during COVID-19. I guess the question that I think you're really hinting at is, was this a one-off event where all of a sudden we were using Zoom and now we're going to go back to normal life, or we just played a bunch of video games and now we're going to go back outside? Or was this a change in consumer habits and preferences and the way that we live our everyday lives? And that's the paradigm shift that I think has actually occurred here. I don't foresee a lot of people deleting their Zoom accounts, even if offices reopen. There's a lot of people who have gotten really comfortable and had a lot of fun playing video games and use it as their primary form of socializing with friends or unwinding after a long day. And I don't think that's going to reverse anytime soon. Think about all the people who now have set up their perfect grocery basket online and just hit reorder once a week, and all those groceries get delivered to their front door. Those people are unlikely to go back to shopping in aisles as well. Some people will go back and some things will go back to normal, but I think the vast majority of people will mostly maintain a lot of these habits that they got very comfortable with in 2020. We're already seeing that. We've seen reopening in a lot of places where people have the choice to go back to groceries, but we're still seeing very strong online grocery sales. People can go play sports again, but we're still seeing really strong engagement in video games and good revenue growth. So the early indication is that this really was a paradigm shift, and a lot of these habits that we formed in 2020 are likely to continue. So frankly, some of these themes have sold off a little bit from their peak, but I think that presents an incredible buying opportunity because these themes are actually more powerful today than they may have been 12 months ago, because they've really kind of continued to prove their value with their user base over the longer term.
I agree with you. I think digitization will continue to accelerate, even though not at the torrid pace that we saw last year. So these areas do look very promising for the longer term focused investors too. And pandemic is actually far from over as of now. Now, I also wanted to talk about some of your very interesting new launches. One of them, which I found very interesting, is the hydrogen ETF, ticker symbol HYDR. Now, we know that hydrogen has been touted as this potential alternative to fossil fuels, and big oil companies are also investing millions of dollars in green hydrogen projects. But these technologies are actually very new and they are not very cost effective as of now. So do you think hydrogen could be the fuel of the future? And also talk to us about your ETF.
Absolutely. Hydrogen is in many ways where lithium batteries were 10 years ago. It's expensive. It's not very well adopted at this point. The infrastructure to support it is a little bit lacking, but the use case for it is incredibly strong. If you compare hydrogen to a lithium ion battery, there's a few key characteristics that make it different. One is it's way lighter. A lithium ion battery is pretty heavy. Hydrogen is lighter than air. So right off the bat, that has some definite value, especially in areas like trucking, where weight is a very big component of the overall cost. The second is you can refuel hydrogen much quicker. So you have to charge a battery, and that can take time. Or you do it really quickly, but that degrades the lifetime of that battery. Hydrogen, you're popping it in, just like it's gasoline. You can just pop it in your car. You have a refueled hydrogen capsule there. So, and the third thing is that it doesn't take a ton of infrastructure to store hydrogen. Batteries, you have to kind of scale linearly to have more storage. Hydrogen, you can kind of produce hydrogen and store it in a much more effective way at utility scale. So you combine those things together, and it makes a lot of sense as a fuel source, not to displace lithium-ion batteries, but as a complement primarily. The way that we're going to get there is primarily by having more renewable energy on the grid. If we have more solar and we have more wind, and we're generating more electricity than we need at any given time, you can take that excess electricity and basically apply it to water, separate oxygen and hydrogen, capture the hydrogen, and create a hydrogen capsule that you use ultimately in a fuel cell. So it's a very powerful green technology, but it's dependent on the entire green ecosystem really evolving together to be successful. So we're still very early in this theme. We're getting exposure to it in our ETF. Various companies involved in hydrogen, from developing fuel cells and electrolyzers, or trying to create hydrogen infrastructure in a more broad way. But it is very early, and I think we could see, hopefully see a similar trajectory as to what we've seen in lithium-ion batteries over the last 10 years, where those prices come down, the infrastructure gets built out, and you have broadening use cases with more forms of transportation that accept that fuel.
Definitely an area with a lot of potential, and where we will see a lot of developments in the coming years. Now, another ETF, very interesting ETF that you launched recently, is the AgTech ETF, and ticker symbol is KROP, KROP, excellent ticker symbol. And we know that global population is growing fast, so we will need more food for this growing population. So tell us about this ETF and how it can benefit from growing demand for food, which may also result in increase in food prices.
Crop is one of my favorite themes right now because it's being driven by so many different powerful macro level forces. When we look across the thematic landscape, we try to understand what is really kind of the macro force that's powering this theme forward. Sometimes it's just, the advancement of a technology. Sometimes it's changing consumer preferences or changing demographics, or it's changing relationship with the environment and changing needs for the environment. AgTech is squarely at the center of all three. On one hand, you have technology progressing, so you can edit seeds so that they're more resistant to diseases, or require less water, or yield more fruit or vegetables per plant. You can do these modifications that really kind of improve the seed. There's other technologies, though. You can have drones that are scanning fields for crop yields and conducting real-time analysis. You have tractors that can be autonomous so that they don't need people driving them. You can have precision watering and precision spraying that uses less water and less chemicals in the process. So you have this incredible technology being applied to the agricultural space. But then going over to the demographic space, what you were mentioning, Nina, we have growing populations, and not just growing populations, but we have rising wealth in populations, particularly within the emerging market middle class. There's billions of people that are going to really change their dietary habits to consume more expensive foods, whether that's milk and meat, or fruits and other types of food that tend to be more expensive. As we see more, millions and millions of people enter the middle class, we're going to need to have a lot more crops available to them and produce them in a much more efficient way. So you have that demographic tailwind. And then the third tailwind is the changing relationship with the climate, that we're starting to see more disasters. We're starting to see more droughts, more floods. Just in the last few years, we've seen, lots of flooding and droughts that have really affected global agricultural prices. If you can create more, resistant crops to those challenges, or if you can grow crops in more places because they're more resilient to different types of weather, that can be really powerful as well. So there's so many different drivers to this theme. In our view, that just makes it extremely powerful over the next decade or so.
Very interesting, definitely. Now, I wanted to talk about an area which doesn't have an ETF. And normally, when we think of a theme or an asset class or any area of the market, there's an ETF for that. But Bitcoin, there's no Bitcoin ETF in the US as of now. And ETF providers have been trying for a Bitcoin ETF for the past 8 years or so. And all those requests have been denied by the SEC. Crypto market capitalization now exceeds $2 trillion. And there's a lot of insane amount of pent-up demand for a crypto ETF. And as of now, there are more than 20 Bitcoin ETF filings in the US. And Gary Gensler, SEC chair, recently indicated being more receptive to a Bitcoin futures ETF. So there's a possibility that we could see a Bitcoin futures ETF maybe this year or maybe early next year. Global X has filed for 2 Bitcoin ETFs, one in July that would hold Bitcoin. And then last month, you also filed for a Bitcoin ETF, for an ETF that would hold 25% in Bitcoin futures and the rest in digital asset mining applications, etc. Now, I know that you cannot talk about your filings, but do you think we will see a Bitcoin ETF anytime soon in the US? And I also wanted to talk about blockchain ETFs. So normally investors associate blockchain with crypto, and usually crypto-related companies and blockchain-related companies, they also go up when Bitcoin goes up. But blockchain is actually a very powerful technology that has many applications beyond cryptocurrencies. And you launched a blockchain ETF recently. So talk to us about your thoughts in general about a Bitcoin ETF and also your blockchain ETF.
Sure. It's very hard to predict what the SEC might do on the Bitcoin side of things. I think we remain hopeful, but in the meantime, there are other solutions for trying to get that type of exposure. Specifically within the blockchain space, there are a lot of equities that exhibit pretty high correlation to Bitcoin. Some of those equities are, the MicroStrategies of the world that are physically holding Bitcoin on their balance sheet, and therefore, in some ways are kind of like a closed-end fund for Bitcoin. But also there's a pretty diverse group of Bitcoin mining companies. And just like a gold mining company tends to be correlated, although leveraged to the price of gold, Bitcoin miners exhibit a pretty similar relationship with Bitcoin prices. They have the fixed costs of mining, of buying their rigs and the electricity that goes into them. So if the price of Bitcoin fluctuates, they tend to have a bit of a leveraged exposure to that. So when you look at the equity space, you can get Bitcoin-like exposure with some correlation there through certain segments of the blockchain space. But that's not the entire blockchain ecosystem. There's the exchanges as well that are facilitating the buying and selling of crypto. Those tend to be somewhat leveraged to Bitcoin prices as well, or at least kind of Bitcoin volatility. There's companies that are pushing blockchain applications forward beyond the financial space or beyond the crypto space, looking at areas where you could use blockchain in supply chain management or healthcare records or smart contracts in a legal capacity. So there's a lot of areas to the blockchain space. For now, I think the equity, blockchain equities is really kind of the best exposure people can get through the ETF structure. But there is still going to be, certainly a flavor of Bitcoin through those correlations.
Now, switching gears a little bit, I wanted to talk about China exposure. Now, all the themes that we discussed today and we discussed earlier, and all your thematic ETFs, they have global exposure because these are global themes. And with global exposure, they also have a lot of exposure to China. And we know that Chinese companies have been beaten down since February because of regulatory crackdown in the country. So are you worried about Chinese exposure in these thematic ETFs?
Yeah, it's a fascinating question. In China right now, there's a really interesting tension between the government and its leading corporations, where the government has certain goals for its economy and for its society. And they really want to make sure that the companies that are major players in that economy and society are aligned with their objectives. So what we've seen is several companies, whether it's Didi and concerns around privacy sharing, or if it's Meituan and its policies around how much it's paying its drivers, or education companies and how they're going about extracurricular education. The government has said, we don't like what you're doing. We have a view of society and you're not playing into that view. And they've, slapped these companies down pretty hard because of that. But there are some interesting parallels to those examples that I just mentioned with what we see in the United States too. We have questions about Uber and Lyft and how they pay their drivers. We have questions about data privacy. We have questions about education and its impact on society as well. So in many ways, what's happening in China mirrors a lot of what's happening in the United States. The difference being the government in China has taken very forceful and swift action against it, whereas in the United States, we haven't seen a lot of policy against these things yet, or it's more kind of state by state at this point. So the question is really, what does that mean? And immediately we've seen a lot of companies sell off pretty significantly in China, given increased regulatory scrutiny. But I think in many ways, people are kind of mixing up some of the short-term and long-term opportunities here. In the short term, more regulation, probably challenging for these companies. But in the long term, if they're able to create more sustainable businesses, or if the overall Chinese economy is able to be more stable because of these changes, and these are the biggest companies in one of the biggest countries and economies in the world, this might actually play to their benefit. And maybe the government is taking just a very long-term view here and deciding this is better, not today, but this is better 10 years from now or 20 years from now. Then that could be really positive. And if you're a thematic investor, you should be thinking 10 or 20 years out. So I'm not so certain that these Chinese regulations are necessarily a bad thing for investors over the long run.
Excellent. I totally agree with you that the short-term outlook remains very cloudy, but in the longer term, it makes sense to remain invested in these companies that have a lot of promising potential in the coming years. That's all we have time for today. Jay, thanks so much for joining us.
Thanks for having me.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.